So, all right. So a network disconnected. I don't know why. Network disconnected. So we're talking about top-down analysis. Top-down analysis. Top-down analysis is key. Is key. It's a professional way of entering, of approaching the market. A professional way of approaching the market. At least you must have three time frames that you're working with. Three time frames. Three time frames. Usually we have the law of 4 on 6. So that means if you want to enter market on 50 minutes, okay, you must be able to, 50 minutes times 4 is 1 hour. Analyze your market on 1 hour before you enter market of. You should be able to analyze your market on 4 hours. On 4 hours. If you want to enter market on 4 hours, 4 times 6. The rules of 4 or 6, 4, 4, 6. There's a rule of 4, 6. That means you go times 4 ahead or times 6 ahead of the time frame on which you want to enter the market. So it's very important. So that means if you, first of all, the first thing you want to know is what is the trend of the market? What is the trend of this market? Daily time frame to know the trend of the market. Then you come to 4 hours. Analyze your market on 4 hours. Analyze you draw your support and resistance on 4 hours. You draw your trend lines on 4 hours, and then you be looking. Then you switch to 1 hour to check your reversal candlesticks on 1 hour. Check your reversal candlesticks on 1 hour, and then you'll be looking forward to enter your trade on either 1 hour or 15 minutes. Either of them is okay. But then if you want to enter market on 15 minutes, you don't have business. You don't. If you want to enter your market on 5 minutes, you don't have business with daily time frame. You may not even have so much business with 4 hours. Just 1 hour, 1 hour analysis will be sufficient. Okay, 1 hour analysis is sufficient. And one of those trainings in the past, I already shared with you the four categories of trader. We have the scalper, we have the day trader, the swing traders, and investors. Okay, if you're a scalper, the scalper enter trade within 1 minute, 2 minutes, and then maybe the highest time frame a scalper will use maybe is 15 minutes. I mean, time frame to analyze his market maximum of 1 hour. 1 hour, enter market on 1 minute, on 5 minutes is gone. But you see, a day trader, is a little bit higher than that. Okay, a day trader can even uses 1 hour, 4 hours to analyze his market, then perfected it on 1 hour, then probably looking at entry on 15 minutes. Entry on 15 minutes. Except trading news, I use minimum of 15 minutes. Except on trading news, I use minimum of 15 minutes. Minimum of 15 minutes for my entry. And so that's top-down analysis. And if you have been following very well, we have done that a couple of times. When I would draw support and resistance, or draw a trend line on 4 hours, and I say, okay, let's switch to 1 hour, and then you readjust your trend line on 1 hour. Then you're looking forward for a reversal candlesticks, and then I can switch to 15 minutes to check for a pullback and return. There's something called pullback and return. I've never even heard that anywhere in the world, but I know that is a professional way of trading. When you see markets has broken a trend line, then you don't enter immediately. You wait for a little pullback, then let it return to the direction of the breakout. Okay, it's not really retest because it may not necessarily get to retesting the broken trend line or broken horizontal support or resistance, but it's pullback and return. I call it pullback and return. I don't know what anyone else call it in the world. That's personal to me, pullback and return. So that's top-down analysis. Let's do something about that on the chart tonight, and let me also show you what I intend to share with you tonight. So there is something called chart pattern. Chart pattern. Chart pattern is very, very important if you're going to be trading professionally. Chart pattern. And if you see, you discover that we have actually talked about it, but let's bring it out and study chart pattern, on their own. Let's study chart pattern, you know. Let's bring that topic out and let's extensively look into it. But for the purpose of this class, I've reduced all these manner different kind of chart pattern. Why? Because if I already taught you trend line and trend line breakout, you literally don't need most of these different name they give to chart pattern. The flag, the bullish triangle, the bearish triangle, the this one and that one. You don't really need them. You don't need them. Because if I've not taught you trend line breakouts or this or trend line, I may be compelled to start mentioning all of those different chart pattern, but I will teach you just a few of them that you can't but master. You cannot but master a few of them I'm ready to share with you tonight. So chart patterns are repeating price structures formed by market participants, participant behavior, psychology, and order flow. Okay, it is a repeating structure. The reason we study them because the structure that you find several times on your chart, several times within a short time frame in the market, several times you will find chart pattern almost in every aspect of your screen when you open your chart. Okay, and why do they work? Chart pattern work because market moves in waves. Market moves in waves. And the beautiful thing is that you need to understand institutional way of trading. You need to understand that the people that provide liquidity in the market, they don't necessarily look at what we look at. They don't treat buy and sell. They have penny order stacked. They stacked penny order. So at the reacting in a particular way. So people have mastered these reactions that price move based on human psychology and uh, based on institutional, planting um, planting orders in the market. You have studied them and come up with certain repetitive patterns that you must master. Why? Because you see, why chart patterns work? Chart pattern work because market move in waves. Trader react similarly to price. You see, people have human behavior can be reflected in the charts. Human behavior can be reflected. And see, so because of the study of how people behave, you will see that there are certain patterns that worth learning and worth mastering. Institutional accumulating and distributed position gradually, just like I told you. They stack, institutions stack. See, and that will make you, when you understand the way institutions stack their pending order, how they plant and stack pending order, it'll be interesting for you. Vast. It is just a prover. It was planted that way. And another reason why chart pattern works because history repeat itself. History repeat itself. Oh, why is this disconnecting? For God's sake. History repeat itself. History repeat itself. I need to understand that. You need to understand that history always find a way of repeating itself. History repeat itself. So human behavior repeated over and over on the chart can be seen repeated over and over on a chart. And I like you to pay attention to that. History repeats. For example, you know, you know, for example, for a beginner stay the moment they see little profit, they close very soon. They close too soon. They endure losses in hope. Hope. I told you the other day that this financial market runs on three human behaviors: hope, fear, and greed. Hope, fear, and greed. That those are the three things markets is established. So you are not being able to manage your hope, your fear, your greed. You're not able to succeed in trading financial markets. So important. And so chart pattern, chart pattern. There are three classifications of chart pattern: the continuation patterns, that suggest that price will continue in the same direction, the reversal patterns, okay, and then the same suggest that trend is changing direction, and then the neutral pattern. The neutral pattern is also when you can't really tell where the price is going to be breaking into, whether to the upside or the downside, until price breaks out. Okay, we call it neutral pattern. Neutral pattern. For example, one of the example of neutral pattern is a rectangle, is a ranging market, is a ranging market, is a ranging market. For example, if you see a box, if you see if you know, interestingly, that's the first way I learned to trade financial market. Interestingly, I traded neutral pattern many years ago, or a couple of years ago. I traded neutral pattern. For example, if I when I see a consolidation, that's the first thing that my coach taught me. When I see a consolidation like this, price is moving up, it's getting to resistance, it's coming down, it's got to support, it's pulling back up, it's got to resistance, it's sending back. What my coach taught me then was just don't do anything. Don't do anything. Watch out for where it will break to. Watch out for where it will break into. If the price break to the upside, it said buy. It breaks to the downside, it said sell. That is bilateral or neutral pattern in a ranging market. When the market is ranging to the up, to the side, to the up, to the down, you watch how far it's going to range, and then you draw your line. Will enter as soon as there's a breakout. Okay, but see, a conservative trader will wait, and when price breaks to the outside, how many of you can see my screen? Oh my goodness. That's bilateral movement. So let's go to the next slide. Yeah, I've already explained this. Let's go to the next one. The next one is the reversal chart patterns. And here we have what we call the double top and double bottom. The double top, double bottom, where you have two peaks and two troughs. Then it gives you a neckline. Then you have the break of neckline. Then you enter the market. I'm going to be explaining that to you in a moment. So reversal chart pattern, double top, double bottom. Now let me tell you something. This double top, double bottom, you cannot do without it. If you want to be profitable in the market, you cannot do it without. You have the double top. Okay. You have the double top as number one. You have the double top. Then you have the double bottom. Then we have the two peaks or two troughs. For double top, we have two peaks. We have two peaks. Okay. Then for double bottom, we have two troughs. You have two troughs. And you need to understand that the price is usually, the reason why it's double top is that the two peaks are on the same price or relatively the same price or relatively the same price. Then you're going to form a neck. A neck is where the lowest, the most recent low or high reverses. So then we have the break of neckline. Then we have this is how the double top looks like. Price is moving to the upside, and then it pulls back. Then it pull up again, and instead of closing higher than that, it decided to stop and reverse at the same top, at the same price where the previous resistance was. Is dropping at the same price. Then begins to come down. It has successfully formed a double top. Then there's a law that says where this first pullback is, the most recent pullback, where the most recent support is called the neckline. A school of thought say wait for the neckline to be broken, and then you sell at the break of the neckline. And what is believed is that the distance between this last support that was created, okay, to the support, to the resistance rather, from the neckline to the resistance. School of thought believe that the price will break to this downside with the same distance it has between the neckline and um, the previous peak. Between here and here will definitely be between here and where, that definitely there is a certainty that price will move this same distance it used to move between the neckline and the peak. That is school of thought. Okay, that is school of thought. That be, don't worry, I'm going to show you all of them in the chat. Then we have another one we call the 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 then another one we call the head and shoulders, the head and shoulders and inverse head and shoulders. Don't mind me, I was trying to quickly write. Uh, so when you have something like this, when you have something like this, when you have something like this, head and shoulders. So we have all of, you see price moving to the upside and then comes down, then close higher high, then it comes down again. And when it's coming down, it's not breaking this neck. And sometimes it could break it and it could slant. But then it goes up to form um another peak that aligns with this particular um resistance here. It aligns perfectly well. It aligns perfectly well. It means it has formed two shoulders and one head, just like the head over your on your neck, your head and your two shoulders. That's what they call head and shoulders. And when it happens in the opposite direction, it is called inverse head and shoulders. Inverse head and shoulders. Inverse head and shoulders. So when it happens at the bottom of a trend, it is called inverse head and shoulders. When it happens at the top of a trend, it's called the head and shoulders. Head and shoulders. That's how it works. It's beautiful when we show it on the chart. It's beautiful when we show it on the chart. Um, so usually the focus is always at this neckline. So when you enter the market at the break of this neckline, you discover that price will definitely move with the same distance it has moved. This is the golden rule. And I want you to pay attention to what I want to type here, what I want to say here. Now, I'm going to type it in capital letters. Look for double top in a look for double top in a downtrend. Look for double top in a downtrend. And look for double look for double bottom. Look for double bottom in an uptrend. Very important. Then look for head and shoulders in a downtrend and look for inverse head and for head and shoulders in and up trend. Very important. Very important. Look for double top in a downtrend. Look for double bottom in an uptrend. Look for head and shoulders in a downtrend. Look for inverse head and shoulders in an uptrend. Period. Very important. So let's this network has logged me out again.